So look, welcome everyone. Thanks for joining or registering for our Stronger Together webinar today. So this presentation today we will be talking about all things in the ag finance market, some of the challenges in the ag space, the opportunities, and then some off-farm investments. Strategies that may strengthen your business going forward. This presentation is being recorded, and so anyone that's registered that misses it will be sent out. But even if you have to leave early, this presentation will also be sent around. My name is Henry Holcomb. I'm with SproutAg Agribusiness and joined with Alex Jackson here, and we've got from Elevate Equity, we've got Siggy Walsh and Michael McIntosh. So lucky to have these guys not only in Gundy but here for this webinar today. So we might get started with the presentation. Look, a little bit about, as I said, my name is Henry Holcomb, SproutAg Agribusiness. We're essentially a finance advisory firm, and we largely specialise in finance and raising finance for our rural clients, specifically around, predominantly, I guess it's around rural debt, property acquisitions, equipment finance, livestock, cropping, but also in commercial property, residential property, and various other investment strategies that are in place. So I just wanted to give you a bit of a snapshot, I guess, on what it is that we do. That's not for that one. The other thing is we do a lot of business advisory services, and specifically with that, it's all about strategic planning with our clients. We do a lot of work with their goals, what they're wanting to achieve in the short, medium, and long term, and we formulate a lot of strategies to ensure that these goals are not only achieved and met, but certainly met, sooner rather than later. The other element of what we do is a lot of succession planning. So it's a part of the business that is relevant in all business, but certainly something that's more prevalent and closer to the heartstrings in the ag space. So we've been running a lot of workshops and seminars and webinars on succession planning, and some of you might have been lucky enough to attend these. But if any of these core services of SproutAg are something that are of interest to yourselves, look, I encourage you to reach out after the webinar this evening. So if we just move forward, Alex. So again, a bit of a snapshot. Look, we look after a bit over 2,000 clients. This is a little bit outdated. I think we've got 10 offices now. We do about 800 mil in new lending each year. We've actually done probably closer to 80 succession plans to date, and we've got about, dare I say, 40 staff across the Sprout network. If we keep clicking, there we go. So just a bit of agenda this evening. Look, we'll touch on the changing finance environment and what's driving that change. We'll talk about the importance of managing the controllables. We'll do a bit of a deep dive in off-farm investments, and Alex will run us through a number of case studies where we've worked with our clients and assisted them in an off-farm investment strategy. We'll have the type of questions, and then we'll make an introduction to Elevate Equity. With the questions, as I touched on earlier, there's a questions box that you can type them in, and we'll try, if we have time, to get back to most of those questions. So to get things started, when we talk about the changing finance environment, I'm really talking about how people are accessing funds these days, and that's really changed considerably over the past 20 years. If we look at the residential space in this graph, it shows the percentage of home loans that were written by brokers back in the year 2000, and that accounted for about 20% of all home loans. Now, if we fast forward to 2025, that's now closer to actually 75 to 80% of what's written by brokers. In the business loan space, back in 2000, it was around less than 1% was written by brokers or intermediaries. Now it's closer to 40%, and this is increasing year on year and doubling year on year rapidly ever since largely COVID. Now, what are the things driving these changes? Well, there's a number of them. Alex. There's a number of things that are driving this change. Now, in recent times, there's been a lot of talk and focus around interest rates and ensuring clients are getting the best bang for their buck with their interest rates. And the other thing is the ongoing debt management support that typically brokers and intermediaries provide. There's a lot of complexities now becoming involved in the bank, and that's something that's been driven by Royal Commission, but also the ongoing scrutiny of banks. So our ability to access funds is getting more and more difficult. So it's another major driver for why people are using intermediaries and advisors within their business. Sorry, we're just working through some.
Still see the screen.
Can everyone still see that screen? Just check the questions box.
That is good now.
Yep, you can see it. Yep.
Yeah.
Okay. You can see it, see?
Okay, we'll just keep going. Yeah.
Okay, so they're the main drivers of the change. And if we just click over. So again, this is just a bit more of a snapshot. If you were to go direct to bank, you're really limited to that single bank's offerings. If you use a broker, I've got access to dozens of lenders and a number of products. And when I talk about lenders, we're talking obviously your main banks, we're talking private equity, we're talking second-tier lenders, non-bank lenders. So there's a variety of providers in the market. When we go direct to bank, we're really limited to a strict adherence to one internal credit policy. Through a broker, typically they can pivot to a number of lenders depending on your business and what's the best fit for your business. There's post-settlement, there's ongoing support and advisory services that come with the broker, and typically a lot of the fees are actually covered by the banks themselves. So there are a couple of the key drivers that are seeing people move more towards intermediaries and advisories to assist in managing their debt. And why that's important is the next slide will show where our debt levels have gone, if we can. So if we're looking at this table, you can really see where debt levels have gone since early 2019 to the end of 2024. So we've gone for about over 5 years, roughly 70 billion to close to 130 billion. So we're nearly doubling our debt load. And this is a really critical reason why we need to be on top of managing our debt and how it's structured and the cost of that debt. Because we're all aware of what interest rates are doing in the marketplace, but also not just other interest rates, but also what inputs to production, whether it be machinery, whether it be fertiliser and fuel, whether it be labour, all inputs are going up. And so the importance of managing these controllables is becoming more and more critical as we see our debt levels double. Now, the next slide, on one hand, we obviously have our rising debt levels. This slide looks at our cash return over the past 25 years, which is, if we look at the orange line, it's our cash return in the ag space as an industry. Now, it fluctuates dramatically and it's largely impacted by seasonal conditions, but also commodity prices plays a vital role there. So through this period, the cash return in ag has been a mere 1.61%. So it's not a great cash return. So on one hand, we have debt levels in this space largely doubling, and we've got a cash return of 1.61%. So the importance of managing the controllables in our business is critical to maintain those profit margins. So it's not all doom and gloom. There is a lot of positives, and what sets ag apart from the rest is our balance sheet. Generally in the ag space, we have strong balance sheets, which is represented firstly by the thin blue line at the top, which is the ratio, which is about 91%. Sorry, it's about 86% over the past 20 years is the average, but it's reached at the end of 22 closer to 91%. The thin blue line, lighter blue line or green line, it represents the dollar value in equity. And we've all known what real estate values have done over the past 5 years. And it's created a real opportunity because if we look at the end of 22, we're around that 11 mil on average in surplus equity in these businesses. Now, one of the challenges that we see in the ag space is being able to realise that equity. In a lot of the cases, we don't realise it until we actually sell an asset. However, there is an opportunity at the moment to put some of this equity to work and further generate generational wealth by leveraging up against some of this equity into positively geared assets. And that's what takes us to off-farm investments. We can certainly grow the business and utilise this equity internally by improving efficiencies and production efficiencies within it, but certainly off-farm investments can play a vital role in generating overall long-term wealth. So the first, when we're talking about off-farm investments, I guess the most obvious one and the one that we see the most, a lot of our clients already have on their balance sheets is residential property. It's the most advertised commodity generally in the market. It's very emotive and it's something that we're all very familiar with. Now, when we look at the industry numbers over the past 20 years, the average cash return or net rental yield after expenses is 2.4% in residential property. Capital growth is 7.3% and total annual growth is 9.7%. But the key figure we really look at is the net cash return of 2.4%. If we are debt funding and utilising our equity into residential property, one of the challenges we'll see under current market conditions where interest rates are at 5 to 5.5% and our cash return is 2.4%, straight away it's negatively geared. The cash return, it will not be meeting our interest repayments. So for an ag business that typically has a weak cash flow or a cash return of 1.61%, we potentially would be partnering up with a residential asset that the farming business is having to further cash flow, putting further cash constraints on that little business. Shares, another really common asset. Cash return 4.68%, capital growth 3.28%, annual growth 7.96%. These are just industry average numbers. So I just want to highlight that you can do better and you can do worse, but if we're just looking at industry average numbers, these are what we're seeing. Challenges with shares is it's very hard to leverage into shares. A lot of the banks and lenders out there, there's a lot more policy and restrictions around margin lending or lending for the purpose of acquiring shares. So we're really limited to a cash play there. Commercial property is the third off-farm investment, something that's probably gets overlooked. It's not in the market. We don't see it as advertised as some of the other instruments. However, when we look at the key numbers, with commercial property, over the past 20 years, the yield is averaging around 7.5%. Now, it's under current markets and the competitiveness at the moment, it's probably, current market would suggest it's probably closer to 7 or 6.5%. And Michael will be able to provide a further update on that. But if we're looking at over the long-term range, it's around that 7.5%. Capital growth 5.48. Total annual growth is close to that 13%. So why is this important to us? Look, when we look at that cash return, if we're leveraging or trying to put our surplus equity to work for us, a commercial property can essentially be fully debt funded and be positively geared from the outset. So the farming business that typically has a weaker cash flow is not having to dip into its pockets to support the off-farm investment. Alternatively, the commercial property is providing surplus cash that can further strengthen the rural business. But ultimately, it all comes back to what the goals and the strategies of your business. If it's capital growth, or potentially, you do look at the residential asset class. But if it's more about building cash flow resilience in your business, well, then potentially, we're looking down this commercial property path. I just want to highlight, obviously, at the moment, there's a lot going on in the world. We've got talks of recession. We've got talks of rising interest rates. In the north of New South Wales and central New South Wales and the east, we've got dry conditions, and there's a lot of talk around that. However, we strongly believe that, if the business is in a good situation and has the ability to acquire, or it meets the goals of the business, if the asset classes have the strong fundamentals about being a good investment, a lot of time it's not about the timing of entering that market, it's about, time in the market. And as if we go back over the past 10 or 15 years, and we were just talking about it amongst ourselves earlier, every 5 years there seemed to be a major change in the global market. If we had the GFC, we've had COVID, we've had the worst drought on record through that 17 through to early 20s. We've had Russia and Ukraine. We've obviously got the conditions we have now. Every few years there's been some triggers in the market that have changed the dynamics. But ultimately, a good investment, should stand the test of time, and that's, I guess, why we strongly rely and utilise people with the speciality in their industries like Elevate to ensure that if we are making a play on investment, that it is a measured approach. So look, I just wanted to touch on that because it's obviously quite timely, and here we are talking investments, but a lot of the time with our investments, they're a long-term play. So commercial property, go back to commercial property. Look, how does commercial property complement ag? Look, as I said earlier, it's not a cash constraint on the farm, which already carries a low return on equity. Provide passive income streams to mitigate the need for eroding farm equity in poor farm production years. So in drought years, rather than going to your bank and seeking additional capital or carry support, ultimately, if we have a positively geared off-farm investment, we can rely on that cash flow. You've got the ability to pay it off from the outset, and it can certainly assist in succession planning if the asset can be paid off over time. Unencumbered assets can be passed on to non-working family members. It can fund mum and dad's living expenses. All of these attributes purely because of its positively cash flow capabilities from the outset. So when we've done a lot of our analysis and advisory work with clients around, what paths to take, and when we go through a lot of the industry numbers, we're finding more and more clients are keen to explore the commercial property space a little further. So look, that's it from me. I'll pass on to Alex Jackson, and she's going to run through a little bit more about some case studies from clients that we've dealt with, and also she'll talk about some of the credit policies and variances between a rural credit policy and the commercial policy. Missed a slide there. So just on this one, I just missed a slide. Apologies. So why are we seeing so much little investment in the off-farm space in the ag industry? And again, this is where Alex will really delve into, but it's largely around lack of confidence and expertise in those markets. It's restricting bank policy, and in a lot of cases, the expertise of our particular banker in asset classes that are outside ag, or particularly it's just not part of our investment strategy. So anyway, I will hand over to Alex.
Thanks, Henry. So really important, I think, to highlight some of the differences between our rural finance policies and our commercial property policies. You'd be forgiven for thinking if rural finance is something that you've always done and commercial property is a bit new to you, that all policies are the same. But certainly there are some really key differences between rural lending and commercial property lending. So I just wanted to go through a bit of this with you. Won't delve too much into it. Certainly ask some questions or approach us afterwards if you want me to explain in more detail. But this is something that we really try to go through with clients on an individual basis to make sure that we're meeting these key pillars. Can we meet these banking requirements in terms of investing in commercial property? So some of the really key differences are in rural lending policy, the income source is obviously farm production. From your commercial property, it's your rental income. Risk driver for our rural communities is weather and commodities. Commercial obviously being market and tenant demand. So obviously how much demand is there in terms of the market, and then also, can the property be tenanted? Is it in a particular area where there is demand for that asset class? LVR is another one that is a little bit different to rural lending, loan value ratio, if you're not aware of what LVR stands for. So generally moderate, and that often 60 to 70% in rural lending, whereas commercial property is a little bit more conservative. So we're talking more around that 50 to 70% mark in terms of your funding against your actual property. Obviously, the cash flow pattern for rural lending is seasonally based. There's some lumpy incomes and expenses in rural businesses. Whereas commercial property it's a monthly rental amount, it's a consistent amount over your 12-month period. So very different in terms of your cash flow pattern. Regulatory focus, climate concentration risk for rural, commercial property valuation and serviceability risk. That relationship model that Henry was talking about, obviously with our agri clients, is generally a long-term agribusiness relationship. In terms of that lending policy, whereas commercial property is more transactional and portfolio based. Rural lending, we're looking around that equity of 55% as a group at a minimum. Commercial property lending policy, there's obviously times where you can dip below that 55% equity down to a minimum of 35%. Because there's different risk profiles from the bank's perspective, then obviously that equity figure is a little bit different. Interest cover ratio, generally we're looking at about 2 times from a rural policy perspective. Commercial property lending policy is 1.5 times on actual payments. So what your actual P&I repayments are against your rental income from that property. In terms of term, generally when we're looking at our loan terms, we're 3 to 5 years. For rural lending policy. For commercial property, it's based on your WALE, which WALE stands for weighted average lease expiry. So it's all based around how long is your property tenanted for, how long is that lease, then that's always matched up with your loan terms. For example, if you have a property that's leased for 1.5 years, generally the banks will only lend you for a loan term of 1 year because there's obviously a lease expiry at the end of that term. So that's something that can be, I guess, missed in terms of that policy piece and how you actually structure your funding. If you're not aware of how that's decided. And then obviously repayment capacity, generally rural lending policy is interest only, whereas generally commercial property is principal and interest. So we're talking about amortization or principal and interest repayments from the outset. As Henry said, generally our clients who are investing in these spaces, their rental income is obviously sufficient enough to cover the repayments on these properties. So there is passive income there. Just understanding that they're two very different lending policies and making sure that you're structuring these loans properly and suiting your business the best you can from the outset is really important, and making sure you're getting the right advice from your banker or from your lender. So I just wanted to go through a couple of case studies. The reason for showing you these couple of case studies are two very different studies. We find that it's very helpful for our clients to actually see how this might be relevant in their business and compare themselves to a case study or a client that has actually gone out and invested in commercial property, to see what that would be like in terms of their own businesses. So I'll just quickly take you through these two. This client is a dryland business alongside their daughter and son-in-law. No long-term debt besides working capital facilities. They reached out to SproutAg as they were keen to build resilience into their business by purchasing an off-farm investment. So looking at diversifying away from the farm and obviously understanding that there's a daughter and a son-in-law involved in this business. So really wanted to work towards how can we retire, how can we work towards a succession plan that suits the business. And also looking to include a non-seasonal source of income. So obviously being a dryland farming business, there's very seasonal, lumpy incomes. How can we include a more diversified, more consistent income source into their business? So the outcome for these clients, whenever a client meets with us, we do a full financial review of their business and provide feedback on these key pillars that we need to meet in terms of banking policy. So we did introduce some specialists into the conversation by way of buyers agents and those of the like to obviously help us to help these clients find a commercial property. They utilised equity in their existing rural business to purchase a $6.6 million commercial property with a post-funding equity position as a group of 82%. So why that's highlighted is, obviously, as Henry spoke about before, given where property prices have gone, there is a lot of equity in rural businesses on the balance sheet. So demonstrating that these clients were able to invest in a commercial property, but not to the detriment of their equity position as a group. The property that they purchased was to a national tenant with an initial 4-year lease and 2 5-year options. So a really strong tenant, longer term leases and options there in terms of mitigating a bit of that risk. So just to highlight, this is a bit of the outcome that happened for these clients. We were obviously able to tend to their business, and ultimately these clients refinanced to another bank and were able to save over a 5-year period $400,000 in interest. Plus they were able to seek the funding for the purchase of the commercial property, and they were also able to obtain a 5-year interest only period. So going through that review process, making sure that obviously they had the right facilities in place, but they were also on a market rate in terms of their interest is really important, especially when you're investing in a new asset, because obviously we want to be making sure that net yield is obviously covering these repayments in the short term whilst we're getting into those investment strategies. So, obviously a really huge savings for these farmers as well. So just to quickly go through this second case study, just to show you a bit of a different operation. These guys are a small beef cattle operation, but predominantly contractors. currently have $2.5 million in existing lending and equity at 65%. And so obviously their equity was a little bit lower than the previous case study, but really strong interest cover ratio. So very strong income, strong historical profitability at 5 times interest cover ratio. Again, they were obviously looking to build resilience into their business, being on that lower equity end with an off-farm investment to help build up their asset base, but then also, again, include a non-seasonal source of income. So these clients utilise their equity in their existing rural properties to purchase a 4 mil commercial property, so a bit of a smaller purchase with an equity funding post-equity position of 47%. So demonstrating that whilst rural lending policies generally will be looking at no less than 55%, given that the predominant income from this business is actually commercial, and the clients had really strong serviceability, the bank were willing to fund them into this investment at an equity position of 47%. How they were able to do this is by starting on principal and interest repayments from the outset, which gave them the right financial structure and ensured that they were returning to a stronger equity position within a particular time frame. So ensuring that they were protecting themselves against any future issues that might arise where they may need additional funding for the business. By going on to principal and interest repayments from the outset, it meant that they would return to a stronger equity position sooner. So again, clients went through our tender process and we were able to get them a great outcome and within an interest savings of over 5 years of $577,000, which is a massive amount of money. And obviously a lot of those interest savings are then going back into helping to pay off that investment property over the next 5 years. So it gave the clients a lot of certainty around making sure they were getting the best rate in the market, but also making sure that they could put as much into that investment property as they could to shore up their business and diversify. So a great outcome for them. So that's really it from us. Certainly, if you've got any questions, please pop them in the question box. As I said, I'll run through that pretty quickly. But if you've got any questions, please ask them in the Q&A, or you're happy to take any questions after. I will pass over to Michael now, who will go through his presentation. Thanks, Michael, for joining us.
Thank you, Alex and Henry, and thank you everyone for joining us. Thanks, Siggy, for all your help.
Yes.
So we specialise in assisting clients purchase commercial property. A fair chunk of our business is based around supporting rural families. We also help medical professionals, other professionals, financial advisors, financial professionals, a whole range of people. We purchase property all around Australia. The reason that it's such a strong opportunity for rural families and why we are so passionate about this area is due to the significant equity growth that's happened over the last few years. Many farming businesses have seen a large amount of equity sitting on their balance sheet, which was largely unutilised. This provides a really significant opportunity to strengthen the rural business by diversifying off-farm into cash flow positive assets that will be geographically diversified. They will be the income will be based on different things to the current rural business. It will grow independently of the rural business. And most importantly, it provides significant opportunities down the track. And by opportunities, I mean options, really. So when it comes to succession planning, often in rural businesses, because we're so focused around that one pillar asset or a group of pillar assets that are so structured around agriculture, it can be hard to get money outside of that business to support kids if they want to do different things, or parents. Everyone's been trying really hard. It's just been a lack of really good options. So This opportunity around commercial property is a relatively new opportunity. It wasn't available to certainly the previous generation, and even 15 years ago it wasn't really a thing. It's only been available since probably the last 10 or 12 years as land prices have increased so significantly and created this equity on the balance sheet. That means we can diversify into off-farm income without preventing the core business for many families, which is the rural asset. It doesn't inhibit their ability to continue to grow in that space. Oops. Sorry, I'm bad button. Mostly I won't go on this much because we want to talk about commercial, but mostly people have been exposed to residential property. Henry touched on this earlier. They're generally net yields of 2 to 3%. When they quote yields in residential space, it's always gross yields, so you just need to be careful. They still have outgoings to come out of it, and that is by far and away the most significant difference to residential and commercial. In residential, the landlord, the investor, has to pay for the outgoings, and in commercial, the tenants pay for the outgoings. Other significant things are the residential space will continue to be influenced by governments and the media. I say this a bit, but as we go forward, it's harder and harder for young people and many families in Australia to own their own home. So that means that moving forward, there'll be a greater proportion of the population that are renters and therefore a lot of voters that are renters. So governments will continue to want to stick their nose in that space, really for the benefit of the tenant and not so much the landlord. Just shorter leases, negatively cash flow. Commercial, much more secure, long leases. It's based around business proposition and business decision. So there's just a lot less emotion in the commercial space. I'll just touch quickly on what are outgoings, because I said that a really strong difference between residential and commercial is that in commercial, the tenants pay the outgoings. So there'll be all your statutory and government charges around rates, land tax. Land tax is a big one, waste management. They will even pay the insurance on your property. The property management fees your tenants will pay to have for you to have a property manager looking after all the small things associated with that property. They have to service the air conditioning systems. Compliance and safety are the tenant's responsibility, and if there's a body corp, then that will be part of the fees that they pay. A really important difference, because that can erode, as you know. It's one thing to say you're getting maybe $100,000 a year, but if these things erode at that and it ends up being $80,000, that makes a huge difference. So that's why in commercial we only ever talk net rents, and the reason that we focus on net rents is because, being a business proposition, we need to know what it is that's going to be in our pocket at the end of the day. What sort of properties are we talking about? So within commercial, there's industrial. The one on the right's a strata property in Brisbane, the one on the left's up at Mackay, a bigger industrial shed, freestanding one on the left. You own that whole shed. You could rent it out to several tenants, or maybe it's just one. The one on the right, you would own just a small portion. So it's a strata titled asset. You would own one unit, the next someone else would own the next, and there would be a body corporate associated with managing that. Medical has been a very resilient part of the market. Incidentally, that last slide being around industrial has probably been, since COVID, the highest growing and one of the most popular parts of the property market, because so many different types of tenants can move into that space. And as we saw since post-COVID, there's been a lot more of this online shopping and stuff like that. So people need places to store their product, to ship them out. They're just so multi-purpose. Medical, obviously, is very resilient around recession, around pandemics. won't be affected too much by fuel prices. People still get sick. Childcare is a good one. They're amazing, these childcare facilities these days. Longer leases, typically 15 years with longer options. We did one the other day in a great growth area for a rural client that had, including options, a lease out to 2062, wasn't it? It's amazing. Anyway, they're a good thing. Retail is very good. We stay away from your strip mall style retail or your main street retail. We don't really do much of that. On the left, they call that large format retail, that office works. Really growing part of the market. Really difficult to manage, great companies, good tenants, pretty well located normally. The one on the right is in a good location. Again, could probably suit a range of different tenants. So that's why we like that sort of stuff as opposed to the stuff in the main street. Office, we stay away from the CBD style office. Since COVID, office was hit pretty hard, retail was hit pretty hard. So we generally are pretty cautious around that space now. However, there are still opportunities there, so we need to keep our minds open, because whenever a market or a section of the market's in a downturn, it might provide opportunities which we can capitalise on. Henry, can you hit a button for me? We got it.
It's just
There you go. So this is a quick example. This is a shed actually down in Tasmania. It's the main logistics hub for Australian independent rural retailers, now a subsidiary of Elders, that they ship out all the stuff to the different stores around Tasmania. This is an example that if you had 1.2 million as a 30% deposit, this is how the numbers would work out. Outgoings for 100% paid by the tenant. All those ones I talked about before, that's written into the lease, so that's guaranteed. They purchased this at an annual rent of 6.5%. By year 5, there's a couple of row guesses there, but by year 5, the rent had increased to 130,000. This is net rent after interest and before principal repayments, and obviously after all expenses. So cash flow surplus to either use for yourself and your family or to pay off principal, 130 grand. By year 10, that had risen to 226. Now we know that these increases occur this way because written into the lease, they have an annual increase to the rent each year. And so we can accurately forecast what rent will be. By year 16, this property has paid itself off. So if we model it, that any of these surpluses go back into paying off principal, then we want to work out and we want to demonstrate when the property could pay itself off without any outside influences. So that would pay itself off in year 16. At that point, you would have $397,000 cash coming in, and by year 20, that's grown to $455,000. So that was all done with $1.2 million deposit. Now, in many rural situations, there is no deposit. We're using 100% equity. So let's look at an example like that. This is a good industrial shed up at Mackay, bought for a rural family, starting net rent 7%, 262 grand income a year. Purchase price was 3.7 million, as I said, fully debt funded. I've assumed an interest rate of 6% on that one. In year 1, it's not going to change your life. $21,000 cash flow positive. Remember though, we've only used equity and put no cash into this thing. So by year 5, again, 70 grand, it's nice to have, probably doesn't change your life. But by year 10, you're starting to go, right, well, there's 156,000. By year 15, it's 285 and grows from there. So if we were looking for, say, an exit plan for the parents from the rural asset, we could just use equity and no cash at the moment. And by year 10, we would have created nearly 60,000. These numbers are assuming there's no market influences, which are typically positive. So over time, rents typically grow quicker than we're forecasting, but we don't want to make assumptions. So what we're doing is just forecasting what's actually in the lease that we can guarantee. The asset value, so the value of the asset is largely pinned to the net income. So they typically say in this area there's a cap rate or a capitalisation rate of, I don't know, say 6.5%, or 7% we would have used in this case because we keep it the same as it was when we purchased it. So as the net rent increases, so too does the asset value based on that net rent. So we know that in year 1 it was about 3.8 million. By year 15 it's grown to 6.1 million. So not only, if I just go back a slide, if I can manage that. Well, I know that in year 10 it was 156,000, and you've also got an asset of 5.1 million. Remembering that we didn't put any cash into this, it was just farm equity. There would be a certain percentage of that number that's grown. Can you, when things stop working? There would still be a percentage of that 5.1 that's owed to the bank, but either way, there'd be 2 or 3 mil there. So the importance of compound, one of the most powerful tools we've got in commercial property is the ability to use leverage and compound growth. Compound growth being that, say, 3% increases are built into the lease. They're 3% on top of a bigger number each time. So over a period of time, they grow really, really significantly. They don't do a lot over the first 3 to 5 years. Doesn't appear like they're doing a lot, but all of a sudden, it gains huge momentum. Leverage is the other thing. So if we were, say, putting in $1 million of cash, it's the ability to turn that $1 million into a property worth $3 million by borrowing money. This means that we gain the income from a $3 million property, we gain the capital gain from a $3 million property. So using, and I guess in the case of just equity alone, that's a more significant example of leveraging. So when they work together, it just really speeds up the asset growth. This is a quick example of a childcare down near Melbourne. This is all within the term of the one lease. So in 2025, the net income was 549,000. Those 3% increases, which are built into the lease, which are guaranteed, will grow to, I can't see that last number, but it's 800 and by the second last year, it's 806,000 anyway. So that's the powerful effect of compound interest. I won't dwell on this. We're just looking for quality functional properties, great locations, population growth. We want to see a clear path for rental income, for capital growth. We want to see good tenants. I'd love to see growth corridors. But most importantly, we need to use strategy over speculation. We want to be well planned and then execute that plan. I just wanted to touch briefly on the current situation. This is the last slide. There's a lot going on, obviously, at the moment around input costs, uncertainty in the market. I think that a strategy that decentralises your income and decentralises your risk is even more important at the moment, or really is highlighted at the moment when these sort of things happen, because there is no commercial property runs on a different engine. It's not exposed to the same risk factors that your farm is or your rural asset. I've made the point there on the left that your wealth's already exposed. So by doing nothing, it doesn't reduce the exposure, it cements it. So I think if we can see the opportunity, if we get to a point where we believe, if you believe that this is a great way to go, then it can really mean that next time one of these hiccups come along, and as Henry mentioned, they tend to come, we'll just be in a much stronger position. So we'll not only de-risk and make your main asset, your rural asset, a much more resilient business, it will down the track provide some really strong options around succession planning. The only other thing, and I'm not going to read all those because I'm aware that we've been rabbiting on for a while, diversification People always talk about diversification with a money sort of, lean to it. Diversification is a farming idea. You've done it all your lives. So you don't plant all your crops in one paddock. You don't plant them all on the one day. You don't sell all your stock on one day, partly for practical reasons, but generally it's developed over time that it's good to spread your risk. So what we're talking about now is applying the same principle you do and always have with your rural business to your capital. Let's spread the risk. Let's be exposed to geographical differences, income differences, different drivers, different risk factors. And I think if we can do all those things, then hopefully we've provided a safer, stronger business and then again, more options for down the track. So thank you.
Great, thanks, Michael. Hopefully you all got a lot out of that, and certainly we always enjoy hearing Michael talk. And the great thing about having Michael and Siggy is Michael's had a long history in farming, but he's certainly been exposed to a number of investment vehicles, whether it be residential, commercial businesses, but also commercial property. So he's got a wealth of knowledge in all those aspects. So very fortunate to have him here. So look, we might move to a few questions. I know there's been a few coming through. So Siggy, if we want to jump on a few.
What's the bit at the very bottom? What's the very bottom?
So there's a question here from Leonie. Henry, how are you working with cash flow expenses at present, considering the increased costs of living and fuel costs? Are you putting a percentage increase on all costs overall or something different? Look, typically, Leonie, we've just been really mindful with our clients, and when we sit down and we review their business and their forecasts, we certainly take have a lens of what's actually happening in the market. We're very conscious about potential increases in rates. We're very conscious about input costs going up. So it's essential that we do build some fat into those cash flow businesses or cash flow forecasts to ensure that any future debt or future investments aren't going to be putting the clients in greater risk. As you'll be aware, with interest rates, the banks typically always sensitise or adds 2% to the current interest rate market. Now, I know there's a lot of talk in the market that rates are going to go up, by another 2 or 3 more rate rises. And there's the talk of recession, there's input costs going up across the board, but essentially we've just got to be realistic around our cash flow forecasting, take some consideration into where market forecasts are saying things are going to get to, and build that fat into our budgets to ensure that we are covered and resilient if those changes come to effect. Hopefully that answers your question.
Got another one. Can I land on Andy's question again? Michael, with outgoings, how does R&M and shop fitting work? Does the tenant pay for that? So shop fitting is a negotiation. Sometimes the tenant will contribute, sometimes the landlord will contribute something, and sometimes they won't, depending on how long the lease is for and the situation. So, but you know that before you commit to it. Repairs and maintenance are the tenant's responsibility, except if it's a capital expense. So if your roof needs replacing, which I've never seen, but as an extreme example, then you would be up for that. But honestly, it just doesn't really happen. So that's one of the great things, is it's capital expenses up to the landlord. The ongoing, just everyday expenses are a tenant responsibility. So, yeah.
Just on that, just further to that, Michael, my understanding is with the utilisation of Elevate, when you do your due diligence, there's a lot of those inspection reports. So In a lot of cases,
Yep.
you know, you're looking at those risks from the outset before clients go into it. Am I right in saying
Yeah,
that?
so Ziggy does our due diligence, and she's excellent at it. So Ziggy will, and I don't want to take away from talking for you, but Ziggy will go through all the recent air conditioning reports, and we'll ring the technicians to see what they said, because often there'll be things that they don't put in a report. We will look at considerable, like anything else, so the fire compliance, the I don't know, I've got a mind blank, but either way, anything that we can find, we will dig deeper and deeper into. We don't take anyone's word for anything. We really need to know that that what we need to do our own research to verify that everything we've been told is true. So we know typically in advance what conditions something is in, and if it looks like that we might have to replace an air conditioning unit in 3 to 5 years, we would probably try and negotiate that into the price, or at the very least, it's just knowing that that's coming up. So a lot of what due diligence is just getting a complete picture about the investment before you actually have to put non-refundable money on the table.
Another question here. What's your take on the actual inflation rate percentage, and how do you factor that into your equations? I guess a few of us can probably touch on that a little bit, but obviously, you know, there's a lot of talk that inflation's obviously on the way up, which will ultimately, and this is why the market's predicting these future rate rises to come into the equation. Look, I think you know, all we can do is really go off of a lot of what the experts are forecasting, and ultimately we're going to see rates increase off the back of this rising inflation. On the other hand, it's also important to note that we've also got unemployment rising, so it's jumped to 4.3%, and there's forecasts of it to go to 4.6%, and there's a heightened risk of inflation. So on one, and that typically has downward pressure on interest rates, but ultimately the RBA is taking the approach of, well, we'll let unemployment go higher and we'll let a recession occur if it has to happen, in a bid to get that inflationary rate down. So they're more concerned about that rate, which, you know, really signals that, you know, we are going to see those rates go up a couple of percent. Interestingly enough, a lot of the forecasts are seeing that we'll get to a high of about 4.85% on an RBA cash rate, pardon me, before interest rates start to come back. So in April 27, a lot of the forecast has rates being back to around 4.1 to 3.85%. So they're starting to climb in 12 months. So it's a real unknown at the moment about what's occurring globally. But if we go off the information to hand and what all the experts are saying, look, we're likely to see these inflationary pressures. We're likely to see interest rates go up potentially, but we would ideally see that level out within a 12-month time frame. So when we're looking at or talking with our lenders or with our clients, and we're talking about our business, whether it be our rural business, we're not in the rural game for 12 months. We're a 10-year play, we're a 5-year play. So it's a hiccup in the cycle, no different to seasonal conditions or commodity price fluctuations. It's another input cost that's going to affect us, but it's a snapshot of the next 12 months. Similarly, if the strategy for the business is to look off farm or look at other alternative investments, and the fundamentals stack up, over the next 5-10 year period, it's going to strengthen the overall business. But we really need to be taking a more holistic and a long-term approach. That's our advice and our conversations that we have with our banks. Fortunately, the banks do take a lot of sensitivity into their analysis. So when we present an analysis document to the bank, which we sensitise, the bank typically will sensitise that further as well. So there's a lot of fat built in there to protect current businesses under these conditions if we're extending further. So hopefully that answers that question.
I just think one thing I want to just touch on there is at the moment there's a little bit of doubt around where things are going to go. So there's doubt in the market. We don't have a clear direction. There's too many moving pieces. So my feeling is that if we're going to talk, if we are, for those that may be interested in off-farm investments, it can be we could potentially be seeing some of the best buying opportunities over the next 6 to 12 months. That doesn't happen overnight, so it's worth having conversations to put ourselves in positions to capitalise on those should they arise. If they don't, there's not a lot lost. But if they do, we could pick up some really strong opportunities. One of the most repeatable wealth building strategies there is to be in a position to capitalise when the market has doubt, because people who are uneducated and potentially trying to navigate these situations on their own will sit out. And so for the ones that have clarity around direction, have clarity around how it can be done, it can be a really strong opportunity. So not every downturn is a negative situation. It can be extremely positive. So one more. It says here, have you experienced challenges with clients not being ready and not having their finance in order? That is one of our biggest challenges. So with commercial property, you know what the income is, you know what the expenses are going to be and who's going to pay them. So it's not, if you borrow money around commercial property, it doesn't have the same risk profile as you may be used to. We know what the income is, we know what the expenses are going to be, we know how we can deal with the debt and what our strategy is there. The one thing we can influence is the interest rate. So I think it's very important to lean on every lever, every tool you have to try and get the best rate possible, because that will obviously increase the margin you're making. That's why we partner with these guys, because we think they're extremely good at it. But when we see an opportunity around commercial property, particularly in the off-market space, we want to be able to capitalise on that straight away. So we would really encourage people to have early conversations with say Alex and Henry to get everything in order. Have conversations with us if you have interest, and we can have as many. It can take as long as it takes to make sure everyone's comfortable. We want to make sure when we proceed with clarity and that everyone's in a comfortable space. So I think the message there is to get all our ducks in a row early and lean on every professional you can within your ecosystem that can have a positive influence on that space.
Great, thanks, Michael. Thanks, Siggy. Thanks, Alex. Yeah. Look, thanks everyone for jumping on. Look, we might wrap that up. I know we've gone for a bit over an hour tonight. Look, really appreciate you all jumping on and registering. As I touched on earlier, this presentation has been recorded and will be sent to you via email, so you can watch it again and share it to your friends or whatnot. Certainly, if you have further questions, certainly reach out. You should have our contact details and Elevate's contact details in that presentation. And for anyone that's registered, we're certainly offering a free consultation to sit down, just work through your business, have a look at where you currently sit, and if any of these opportunities that we've spoken about today might align with your business. So look, if any of that's of interest, certainly reach out to Alex Jackson and myself. And if you really want to take more of a deep dive into that commercial property space, certainly reach out to Siggy and Michael. But look, we'll wrap it up. Enjoy your evening, and I hope you all saw some value in tonight.
Thank you.
Thank you.